Good morning, good afternoon, good evening, folks. It is Monday, and we close it out strong with my weekly expert, Emil. How you doing, sir?
I'm doing great. Happy
Hey,
Monday.
man. You've been doing great stuff for us, researching cities and metros and summarizing all of that stuff. What I want to do this week is I want to go back and review the 50-year spreadsheet I put together because I'm actually becoming more convinced we're in the early parts of the 70s. I want to break it down. I want to share my logic. I want you to poke me, point at things that I have wrong or different, and ask questions because sometimes I get ideas in my head and I don't look up and realize I am missing something. So let me pull it up and we'll just start rapping about it. Okay.
Sounds good.
Awesome. So folks, again, what I'm about to share here is something I spent nearly 24 hours putting together. It is 50 years of history. What we are going to do in this example is just look at the 70s. I highlighted it here in orange or peach. Maybe and I'm not going to save this, but this spreadsheet is available to everyone. It is in my free course and my paid course in the bonus sections. So I like purple. We'll make this purple. So, okay. All right. So again, we're just going to look at the 70s here. And I guess the first things I want to point out here, Emil, is this is a decade where the 30-year interest rate rose. Right. You see it here in the 70s, starting at 8.5, 71. So it goes down a little bit, then it ticks up. And it really starts to get cooking in 79. And it actually goes up for the next couple of years. But we're going to do this just 1970s to 79.
Yeah.
And the reason I bring this up is I think it is fair to say that interest rates are likely to be higher in 2029 than they are in 2021. Right. That's the first similarity I see in the 70s. And the reason that 1980 through 2020 aren't here is interest rates essentially went down for 40 years. So we are making we're hitting the bottom and we're ticking up. So that's where I start first. Again, it's anybody's guess. Your crystal ball is just as broken as mine, but is it fair to say that interest rates will likely be higher in 2029 than they are today?
I think so. I think with everything you're seeing, I know the Fed won't say there's inflation going on, but everyone else is seeing everywhere. Writing on the wall. I don't think they have any other choice but to raise them. They've already said they're going to start tapering and rates are likely going up. So
so that's the first thing. I frankly think that's a layup, right? Then the next thing I think about interest rates is you look here and they went up 2.7%, right? From 8.5 to 11.2. Is that right? Yeah, that's 2.7. So then what I do is I go, okay, that's nominal terms. So let's just say interest rates are 3% today, Emil.
Yep.
You add 2.7, that takes us to 5.7%. The first thing I go is, and this again is 30-year. So that probably means the Fed funds rate's got to be, I don't know, 4.25, probably 4. And I start thinking, I don't know if we can get that high. I mean, we did this in 2018. It got a little high, and then they had to whack it back really fast.
Right.
So that's the first thing I ask myself. And I'm pulling up my phone here because I actually want to do some math. So nominal terms, I don't know if we could get to, what would that be? 5.7%. How does that hit you? Does that feel kind of high, or you're like, no, I think we get there pretty easy?
I honestly am questioning, like, do we ever get to, not ever again, but like, what? How do we ever have fives? Like,
yeah, exactly. Right.
It's been so low for so long. And like you mentioned, interest rates started going up and you just felt the shock to the system, and it wasn't even that much higher. It's
but they're like 2.25 or something, Fed funds, or maybe it's 2.5. It just stopped. I mean, you really felt it like late 18, I think it was. So, okay. So nominal terms, I think we both agree, pretty hard to get above 5. So then again, right, numbers guy, I go, okay, well, what is 2.7% of 8.5? So that's let's call it 32% move. So a 32% move from 8.5 to 11. So what is a 32% move from 3? Oh, really easy. 4,
1,
right?
Yeah,
it's basically 1. Hey, shocking. So then I ask myself, okay, could interest rates get to 4% by the end of the decade? And I'm like, yeah, I could see that.
That seems more reasonable.
Yeah. So I think so again, nominal 2.7 takes us from 3 to 5.7. I don't see it. I mean, I think that not that I don't think it needs to happen, but I think it just grinds the economy to a halt, and we just can't pay our debt at some point. Right.
Right.
So I think nominal is out, but a move from 3 to 4%, I think is likely. And frankly, I think it's likely early, probably.
Yeah, when I started in 2017, I think the first interest rate I got was above 4. So to me, that doesn't feel crazy. 5 feels crazy to me just because I've never had that. But
yeah,
4 is totally possible.
I think that's reasonable. So that's the first thing I think about, right? I look at interest rates. Okay, I'm just going to mark these logics off because this is just how my brain works. So let me move your picture because you're hiding my colors. Actually, I guess I could do it this way. So, okay, we talked about that. So we'll make those blue. All right. Okay, move your picture out of the way. And again, folks, you have access to this spreadsheet. You can do your own research. What do I want to do next? Oh, I guess since you guys always ask for CPI, let's talk about CPI, right? Consumer Price Index. It is what it is. It's bad or good, but it's at least a number that's been around a long time. So CPI, right? Above trend, right? 5, 4, and really takes off in 1974, 75, and then has a reemergence late in the year. So again, inflation is one of those things that's sticky. It's not transitory, historically speaking. It can have fits and starts. You can see I guess it bottoms at 3% and peaks at 11 twice. I think inflation is going to be around, as I'm telling people now, the next 5 years, right? For the first half, because, I can't see that far, but again, looking at the 70s, once inflation gets going, it's pretty sticky.
What has CPI been lately?
Oh, let's take a look. I have all the data. So again, just through the end of 2020, it's been below trend. It's been below 2% for quite a while. And recently it's above 5%, right, in 2021.
Okay.
So we're coming off a very low base, but once it gets going, it sticks. And I think a lot of this is going to be wage driven, but we'll get to that in a minute. So I added CPI data because everybody kept asking, where's inflation? Where's inflation? Where's inflation? So it's there. Any questions here or thoughts?
No.
Yeah.
It's pretty straightforward to me.
Okay.
Seems like we're heading there, right?
Yeah.
In the 5s. So
yeah.
Okay.
And then what I did is I looked at wages. Again, we'll make wage growth. Again, you have to take it off a base year. That's why it's not there in the 1970s. Actually, where I want this color, might as well make this yellow, I guess. Just so we can follow along. So you can see wages. Again, I think we have wage growth. I think wage growth is actually the embers that become the fire. That's where it starts. So you can see wage growth really started and then really exploded into the end of the decade. And you can compare wage growth with CPI. Did I do that below? I may have. Let's see. Oh, look at that. I did.
Nice.
Wages minus CPI. So again, when it's negative, that means that CPI was greater than wages. So when it's positive, that means wages beat CPI. So actually, I never did this. Let's do the whole decade, or at least 9 years.
Is that like a simple, crude way to analyze, did purchasing power go up or down?
Exactly.
Negative, less.
Yes, exactly what it is. So essentially what this looks at over the year, and I've never done this math before, is essentially it was flat. It was up 0.8% for the year when you add all the fits and starts, because you're up 4%, you're down 4%. That's right. Interesting. So essentially wages and CPI were even, right? The lines go together when you get rid of the noise of year in and year out. That is very interesting. That really tells me that CPI is wage driven. That is really wild. I never looked at it that way. Oh, that's cool. Okay. But back up here, wage growth. I think wage growth, again, it starts with minimum wage, kind of the service sector. But as those get increases, people with some skills get it, and it just kind of ticks up the ladder. I think wage growth is again, I think it's the embers that become the forest fire of inflation.
I'm curious, why do you think, wages are growing right now because it seems like there's not a lot of talent out there. People need workers and there's not enough, so they have to rate. Why did the economy resetting cause this? Why do you think a shortage in labor?
I think what happened is we have enough jobs, right? We actually have 11 million open jobs, 9 million people unemployed, or whatever the numbers are. But I think what we failed to realize is we've had 18 months of migration, and we've had 18 months of essentially closed borders. I think what we have is a very mismatch of locations, right? We have San Francisco and New York trying to spin up, but they can't hire anybody for the restaurants and in the service sectors, and Broadway on New York is having problems. It's because everybody that worked there couldn't afford to live there without the job and went home. And what they did is when they went home, they've been out for 12, 14, 16 months. They found other things to do and they're not coming back. So I think that's one of these subtleties. And the only way to fix this is New York and San Francisco have dramatically raised wages because they're going to be feeding off a smaller base. They have to raise wages enough to attract migration, which right now people are like, screw it. I'll live in Tennessee or South Carolina or wherever.
Right.
I have a better quality of life. I don't got to pay, $2,000 a month for a shoebox. I'm good. But if you take New York wages to 4x what they were or 2x or whatever, people will come back. And I think that's why wage growth is just starting and why I think it is the thing that really, really starts to feed on itself, because Chipotle told us the answer. They raised wages from, I think, an average of 12.5 to $15. And 30 days later, they raised their prices of everything 4%. Companies are not going to eat the margin, right? They're going to raise the top line. And I think that's happening across the board.
Right. Yeah. We're seeing that with, in what we do with rents going up.
Everything. Yeah. So yeah, I think wage growth starts. I think wage growth feels really, really good until everything's more expensive and you realize your purchasing power sucks. And again, I want to say this: inflation is a tax. It's the greatest tax. It is unfair. It impacts everyone. It impacts the poor the most. And for whatever reason, the government won't call it a tax, but it is without question the greatest tax we all pay.
That's a good way to put it.
Okay, so that's wage growth. And then the last thing for me is homes. Look at this: homes appreciation. In a rising interest rate environment, which people think is impossible.
Yeah, that's what I was thinking too. I'm curious.
Yeah. Real estate goes up 100%. It goes from 24 to 48 grand in a rising interest rate environment.
Yeah. Why do you think that? How does that happen?
It's absolutely wages. It is 100% wages. Your wages went up. I forget what it was, like 88%. Your wage were $8 grand, 8,700 in the beginning, and they're 16 grand at the end. Real estate, homes, rents are 100% based on wages. And if we have wage growth, we will have real estate values grow, even if interest rates go up 32%, which again is 3 to 4% in our environment. We have a decade of experience. In fact, it's the only decade we have of where interest rates rose.
Super interesting. It's crazy to think that after we've had, last 10 years have been really good to real estate investors, to think that could just compound itself this way.
It's nutty. I mean, let's just look at it. Again, I wasn't planning to do this, but you brought it up. The last decade, so that would be 2010. So that's here to essentially here, right? So let's just make this a different color so everybody can see it on the screen. We'll make it yellow. So again, where did real estate start? 180 grand. Into the year, 255. So that's actually not that much. That's 50%, maybe. No, not even that. It's 40%. What happened to wages? So wages were 48 grand to 68 grand. Guys, this is all wages. Let's just do the math, just because I'm a numbers guy. So how would you do this? You would go 68. Let's just do round number, 68 divided by 48. So that's 41% growth in wages, 2010 to 2019. So actually, let's round it up. It's 42%. So let's see what houses did. Well, what is it? 255 divided by 180. Look at that. The exact same number, 41.66%. Shocking, folks. Real estate, home prices is from 2010 to 2019. Home appreciation and wage growth was exactly 41.6%.
Interesting.
Crazy.
Interesting.
And that's why affordability was better, because interest rates went down, right? The interest rate in 2010 was 4.6.
Right.
Oh, actually, it wasn't that much lower. It was only 4.25 in 19.
In 15, it went down, and then they started creeping.
It bounced back up, right? Because again, it went up in 18, right? See, 18, remember we talked about 2018 was that hiccup?
Right.
It hiccuped at 4.5, so it had to come down again. It's all wages, man. It's all wages. It's
interesting.
All wages. Yeah. Crazy. So again, this is what folks, the 50 years is there. And if you want to know the data sources, I linked them all here. You can argue the data, but I only got the data from these links. Go nuts. Challenge the data. It's not my data. This is where it came from. I did highs and lows. I did decades math, right? I summarized all decades. All of this is there in the free course and the paid course in the bonus section. So yeah. Any other questions about all this?
So just to summarize what we're talking about here, the key points. So even if we say interest rates are going to go up, which we both agree, as long as wages go up too, real estate should experience growth in price.
Yeah. Again, it's all wage growth. It's just all wage growth. Again, interest rates went up 270 basis points or 32%, and real estate doubled. Real estate doubled. Yeah.
Do you have rent in here as well?
I did add rent to another spreadsheet, but rents went up. So real estate went up, I think it was 106%. Rents went up 116%.
Wow.
So the whole idea to me is, because when you add rents, which is not on this spreadsheet, but I did capture it for another thing,
right?
Is if this is the playbook, the only answer is you want to buy real estate in 1970 or 71. You want to get 30-year fixed rate mortgage, because if you hold from 1970 to 79, your property portfolio doubles, your rents more than double, and your mortgage payment never moves. How do you like me now? Let's do the math, right? You buy a $24,000 house, you put 10% down, $2,500. So let's just do the math. Let's just try to figure this out. So $24,000. I actually have the numbers here, right? So you put 2,400 down, your payment is 166. By the way, that's row 8 for those that don't see it. So now 1979 comes. And I don't have rent here. I think it was $108. It went to $216. I've done this enough times to remember that. So 1979, now your property is worth $48,800. So first off, folks, your $2,400 got times, it went up 10x. Your $2,400 payment is now worth 24 grand, right? That's the appreciation. Your mortgage payment of 166 is now you're still 166, and your rent doubled, went up more than 100%. So your cash flow is more, your appreciation's more, your payment never changes. It's just life is good. So that's what I'm doing. That's what I keep telling people. I'm trying to buy as much residential real estate. And I say residential because that's what you can get 30-year fixed rate money on. And I'm just going to hold for the whole decade. That's what I'm doing. And this is why this spreadsheet convinced me that this is what I'm trying to do. So what do you think?
I think it's great. I'm starting to see the parallels you're talking about. So
yeah,
I think
and it really challenged, because when I did this, when I did 50 years of research, I had no idea that 1970s was the only decade where rates went up. I didn't know. I didn't realize we had 40 years of essentially falling rates. I didn't realize that incomes doubled in the 70s. That was pretty eye-opening. But then again, I didn't think it doesn't make logical sense. Interest rates went up 32% or 270 basis points, and real estate doubled. I mean, that doesn't logically make sense until you add wages doubled. It's all wages, right? Because borrowing, housing is a borrowed business. It's a leveraged business.
Yep.
Right? So
yeah,
pretty crazy.
Curious, what happened in the 80s?
Oh, we can do that. I can share it. Yeah, I can share it again. Yeah.
Even if you just have like a brief summary.
I don't know. Let's find out. Actually, you know what? I did this all in decades because I didn't know. So the 1980s, home prices went from 55 to 93. They went up 69%. Interest rates dropped 25%. Median income went up 63%. See the link again?
Yep.
And then home price to income, I did that kind of comparison. It went up 3.8%. Just since we'll round it out, since we're doing this side, the 90s, home prices went up 27%. Again, interest rates fell another 25%, roughly. Incomes went up 35%. So incomes went up more than real estate in the 90s. In the 2000s, real estate home prices went up 41%. Rates went down again, 37%. Again, decades of falling rates. Median income went up 25%. This was the decade that rates, housing got a little stretched, and that's what this shows you. And then the 2010 to 19, housing again 41%, and wages nailed it. Again, wages, housing, you're starting to see similarities. And then again, 2020, but anyway, so not a full decade, but yeah.
So interesting. The crazy thing is even you look at a bad time like 2008, if you're looking at decades overall, every single decade you point out here, prices went up.
Yeah.
It'll be really interesting if wages go down and interest rates go up, we're all screwed.
Yeah, exactly. It is all wages, right? But here's the deal, right? So again, the 2000s, we actually had 5 years in a row of negative growth. -4, -8, -2, -4, -1. This stretched into a new decade.
Yeah.
But yeah, we had 5 years of negative growth in housing. Housing doesn't crash suddenly.
Right.
It's,
not
death
the stock market.
Yeah, exactly. Or crypto or whatever. Right.
Right.
But this was the reason that the 2000s were still up is because we had, again.
It's so interesting when you look at home price as a national average versus like boom and bust markets like California, where these negatives would be way bigger.
Yeah. I mean, Fresno was like +20, +25, -30, minus this, minus that. Yeah. But these are national numbers. I had to use something. Yeah.
Right. No, it makes sense. Very cool.
Very cool, man. Well, thank you for going through with this with me. Again, what am I doing because of this? I'm trying to buy as much residential property that cash flows today, no alligators, no appreciation bets, cash flows today, 30-year debt, because I expect inflation to raise my value, raise my rent, and erode my debt. I'm going to use inflation because inflation hits my family like everybody else, but I am going to use inflation to help my family. That's what I'm doing because of that 50 years. Play with the spreadsheet yourself, log in and not buy, it's free. Register for the course, enjoy, have some fun. What do you think?
Do it.
Yes.
Listen to Michael.
There you go. Thanks, buddy, for your time.
Absolutely.